Nigel, what else?
Prashant, Aztec Life Sciences, I don't know what's gone on there, but the stock is surged up close to around 11%. So pull up the intraday chart out there. Volumes as well picking up big time. So that one is spiking up. We'll try to find out what's happening on that front. You have some of these sugar names, as Prashant said. Ugar Sugar, well, that stock is up close to 7%. Volumes picking up out there as well. So keep an eye out on that one. That's doing pretty well. And the other one that we already highlighted, Anthony Waste as well, is higher in trade. So a few stocks in the broader markets, well, they are bucking the trend as we speak. But let's get to Mahesh Patil, CIO Aditya Birla Sun Life AMC, who joins us on the show. Hi, Mahesh. Morning. Thanks so much for joining in. Well, how are you viewing the financial, the banking space? That seems to be a consensus buy out there. Credit offtake is, is picking up. I think in the past you've said that you as well are part of that camp. Is it time now to look at the PSU banking names, or do you think stick to the large private sector banks?
Yeah, good morning. On the banking, I think overall the tailwinds are fairly good. As you said, the credit growth is picking up. It's now in the mid-teens, and that's good. Overall, we're seeing that the corporate credit cycle is looking favorable. So the credit cost there should be lower. And the margins also, the NIMs are likely to improve because the increase in the interest rates, I think some of that benefit, should be retained by the bank because the cost of deposits hasn't gone up as much. So I think overall, the sector, both the private banks as well as the PSU banks should do well. Normally, we've seen that the PSU banks, they do well, when the overall credit growth is stronger because their expenses and their costs, they don't really rise as much. So there is a margin improvement, what we see. And normally the PSU banks are more exposed towards the corporate credit. And there we are seeing that it's looking fairly benign kind of a cycle. A lot of corporates have delevered in the last 2 or 3 years, and their balance sheets are much stronger. And they are in a position now to really start leveraging further. So given that, I think the larger PSU banks, or the better PSU banks, I think they should also do well. So we are also positive on some of the select PSU banks where we see the capital adequacy ratio is good, where the ROAs are improving. But over a longer term, our preference still remains with the private sector banks, which have got a retail focus.
Mahesh, it's consensus, right? To it's a consensus bullish kind of sector. But is it possible? It's widely kind of being understood that the consumer is not really doing all that well. A high-end premium segment is doing well, but sort of mass market, lower end is not doing very well. You said corporate credit is still very benign. So where is a lot of the lending happening to? It's perhaps happening into that segment. Will we will the sector wake up to another headache 3-6 months down the line? Is that a risk which, I mean, no one sees at this point, or you think it's very unlikely?
So I think if you look at the credit growth, demand is coming mainly from if you look at the overall retail, mortgages are strong, showing a strong growth over there, and the revival in the real estate sector is helping over there. So there, one should not see any major pain. I mean, historically, we've seen the sector has behaved fairly well. On the overall retail credit side, I think while there could be some kind of slowdown because of higher inflation, and that could lead some slowdown in terms of consumption. But I think we don't see any large leverage in the retail side. I mean, overall leverage at the retail level is not very large. So given that, and again, we're not seeing any kind of a major stress on the job scenario. So that should lead. The biggest stress testing was done during the COVID time, right? And a lot of the retail side credit book has gone through that kind of test of the pain. So given that scenario, unless there is a serious slowdown in the economy, we don't expect any major pain on that front. And on the corporate side also, while the growth currently is slightly muted, but as one sees some of the corporates start to lever, we've seen slowly, steadily private sector capex starting to pick up. So one would expect corporate credit growth, which was muted, that should also start to pick up in the coming year.
Mahesh, morning. Can you tell us the changes that you've made to your portfolio in the last 3 or 4 months to play the current market scenario, the volatility that we're seeing?
So in the current market, I think while India story looks fairly strong and good, we are not seeing any major impact in the domestic facing sectors. But because of the global slowdown and the sharp increase in interest rates, we have lowered our exposure to some of the stocks, global cyclicals that includes metals to some extent, the IT sector, and other sectors which have got a larger linkage in the to the global growth. On the contrary, we have added a bit to the domestic focus sectors, be it banking, to some extent in the industrial capital goods sector. That's where we are positive. But I think by and large, I think focus in this kind of environment where there is a lot of uncertainty and sectoral also shifts, we are seeing rotation happening very fast. It's still unclear. I think focus is still on individual stocks, companies with good cash flows, earnings visibility. I think it's more bottom up rather than a top down focus what we are adopting in our portfolios.
Mahesh, what about autos? Supply side issues getting sorted out. I understand that demand on ground is pretty good as well. But those stocks have already had a good run after a bit of a slump in the last year. What's your stance on auto stocks as of now? And what's your preference? Are you in the CV bandwagon or do you believe that the other sectors will fire now?
So in autos, we are, outlook is improving, no doubt about that. We've seen the volume pick up, especially in the four-wheelers. That's doing well. Even tractors and other sectors are doing well. Commercial vehicles, after 2-3 years of downturn, we are seeing that pick up slowly on the back of improving economy. So overall, the outlook is definitely looking good. But I think our view on the sector is slightly neutral because the stocks have rallied. Some of these valuations are probably slightly on the higher side. But I think companies which are able to protect their margins or have a pricing power and get the benefit of the lowering of the raw material costs. We see a sharp correction in the material costs, especially steel, aluminium. The metal prices have come down. So companies which have got a better competitive position in the market and pricing power, I think we should see some upgrades to earnings going forward. And that's where we'll be positive on. So that could essentially be in the more in the four-wheeler space rather than the two-wheeler space.
Got it. Mahesh, do you own any of these defense names in your portfolio? Anything new you've added there? And broadly a view? Everything is re-rated now. I mean, the laggards have also now picked up and have done quite well. I'm talking about names like Garden Reach, even Cochin Shipyard. Mazgaon, of course, over the last month is up 45%. Yeah.
So defense, we as a top down, I think it looks fairly exciting because the way the government is focusing in terms of sourcing more from the domestic players, and while the overall defense budgets, we don't see that increasing significantly, but sourcing from domestic players, I think that's likely to go up, and the government has identified various parts and sectors, okay, where we'll do so. So the macro top down story looks good. But when it trickles down, really, there are only a few companies, large names, okay, where we find comfort. But as to also look at this, some of these projects are also long gestation periods. So to what extent one would want to factoring in now and give those multiples is something which we need to look into that. So our preference there would be more on the larger names rather than the small and the medium names.
Would that hold true even for IT companies? You said you pulled back some of these global-facing themes like metals and IT. But if you were to take exposure to IT, would you prefer the larger names out there because maybe they could stand the test of time, they'll have pricing, power with them as well?
Yes, so IT sector, I think now post the correction, what we've seen, almost like a 20% correction or more, they are looking now fairly reasonable in terms of valuations. And even in terms of outlook on growth, while there'll be some moderation, I think the margin pressure, which was expected earlier, is likely to abate because we're seeing the pressure on the wage increases is now kind of easing off. And with rupee depreciating, that should aid. So I think IT sector at this point in time looks fairly okay. The earnings growth should be steady. And a lot of these companies have generated very good free cash flow. So the free cash flow yield there should provide support over there. So while the global sentiment is negative and we've seen correction across IT stocks globally, Indian IT sector, they are focused on digital. I think especially the larger companies, I think should we don't see any major downgrades to earnings. So we are not as negative as what we were earlier and would be probably neutral at this point in time. But you're right. I think the preference would be more for the larger names because in the smaller mid-cap IT names, okay, there could be larger impact because of the slowdown globally, and they could probably face more pressure on the margins. But there again, I think one has to be selective. There are companies in the mid-cap space which are focused on niche segments, which are still doing well. So that differentiation has to come in, especially in the mid-cap side.
Okay, absolutely. Mahesh, it's a pleasure. Thank you very much for joining us with that perspective. Mahesh Patil, one of the largest equity fund managers in the country, with that perspective coming through.